Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the end of the month, it's 31st of July, and our guest today, as always on Monday, is Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, coming out of Singapore. Now, Vishnu, as always, lovely to speak to you on a Monday.
Brian, I have to say it's as much a pleasure ending the month with you as it is a privilege to start the week. So good to be here, sir.
Oh, you're so very kind. Now, Vishnu, for a start there with the start of the week, um, we start the week on poor data. So China's factory activity contracted for the fourth month in a row. It's the start of the week. What should we be looking out for?
Well, I think we should be looking out for, in a nutshell, if I needed to sum it up, after last week, what we need to look out for is whether markets are becoming a bit more circumspect of what otherwise they've converged around the idea of nirvana. Let me explain that. We used
Okay.
to get quite upbeat about the term Goldilocks, where you get the sweet spot scenario. But markets have gone beyond that. They now think we are in a state of nirvana, meaning we've been able to get inflation down. So US disinflation came down. Disinflation worked out very, very emphatically whilst not adversely impacting jobs. So there haven't been job losses per se. In fact, continue to have tight labor markets, job gains, whatnot. And the economy keeps humming along. The US economy, grew at a sizzling pace in Q2, even as inflation fizzled. Hence, the sense of nirvana. And I think the fact that, after the Politburo meeting, China came out, with suggestions that they'll be swinging with the stimulus also added to some of that euphoria around the narrative, which is why markets are fairly buoyant. And you're absolutely right in pointing out that there are data soft spots in China, and even then, the question is, do you frame that as a positive because it's going to lead to more emphatic stimulus? We don't know. I mean, it is nirvana, I guess.
So picking up on the Nirvana theme, actually, if you remember at the start of the year, everyone was very concerned about the impact and the lag impacts on the tremendous rate hikes that we've had over the last year or so. But the thing is, despite inflation, as you just mentioned, being cooled substantially, labor market are tight, whether it's the US, whether it's Australia, for example, where they've had significant rate hikes, but labor markets still remain tight. And despite the fact that there were a lot of doomsdayers around a terrible recession and a slowdown around the world if China didn't come up, despite the poor performance of China, economies in Southeast Asia are still humming around quite nicely. Now, given that scenario, then what should we be looking out for then in the next half of the year? We've got 5 months to go till the end of the year.
Let me first put it out there. I know you are one of the optimistic persons around, but I'm a miserable person. So I'm one of the doomsday kind of leaning person. So what would we look out for? I mean, I agree with you on the data points. The labor market continues to be strong, but the half-empty version of that means that central banks might need to keep rates elevated for a while longer. In fact, that's exactly what the Fed is saying. They say we may be nearing the end, but we are going to keep it higher for longer. That's one aspect of it. The other aspect is the sense of lagged effects. I think we are in a distortionary place because what happened last week was also the fact that you saw the euro coming back off. And that's because the ECB has an open mind, quote unquote, using their terms, about the September meeting, primarily because they've seen, quote unquote, forceful tightening coming through. So they've seen credit tightening more so than the US. US hasn't seen as much. And so the question for us is whether in a post-COVID world, some of the lags and delays are a bit more unpredictable. And rather than decoupling, it's just a delay. And you get credit tightening coming through. So we remained very watchful of Q4, late year or early 2024 tightening that actually slows the global economy down with quite a bit of headwinds. And on the side note on that is, our 1997, 98 experience with the U.S. policy tightening was U.S. averted a recession despite their tightening. The rest of the world had to endure one. So this is why even if we see good numbers in the U.S. like Q2 GDP, we remain somewhat more circumspect about that may mean for the world. And I think in particular, what adds to some of the complexity around it is putting aside stimulus, whether they can get through sufficient stimulus to revive animal spirits, putting that aside, there's still the geopolitical overhang between US and China, and we don't know exactly how that plays out. So the way I look at it is we've got more questions than answers. And I think prematurely concluding that we are at Nirvana uh, is I think, somewhat presumptuous.
On that cautionary note, then, Vishnu, what should we be looking out for in the shorter run this week that could move markets?
Well, we've seen a lot of the major data coming out. So I think one more central bank, the G3, were covered last week, and we saw a plethora of reactions to that, including yen reactions. This week, Bank of England is coming out. So we need to see what the Bank of England does. Like the Fed and the ECB, they're expected to deliver a 25 basis point hike. But unlike the ECB, the sense in the market is that they may come out swinging a little bit more hawkish than restrained. So that's something to look out for. On an immediate basis, it might strengthen the sterling. But if we sit down and think about it, because the recession risks are greater in the UK as it is in the Eurozone, and inflation is stickier, real returns from the UK are not great. So that could lead to much more latent downside volatility in the sterling. And the risk this week, as we don't really grapple with top tier data, but turn of the month PMI numbers, so on and so forth, is we need to balance between whether there is an inflection and turning point in manufacturing, because manufacturing is in a downturn. We also need to
Mhm.
look out for services to see whether services is slowing or not. And we need to put these two together to determine the overall sustained underlying dynamics in terms of aggregate demand. The last thing I want to say is I think markets are getting very enthused about peak Fed, peak ECB, and they're getting quite ebullient about this Nirvana. But as Kurt Cobain said, right? He said, "I much rather be hated for who I am than loved for who I'm not." Markets are loving this situation for a Nirvana economy. They may end up having to hate it for what it really is, which is a pretty fragmented recovery.
On that philosophical note, Vishnu, thank you very much for your insights. Thanks for coming on the show.
My pleasure, Brian.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.